null. Great, we are live today's panel discussion about crypto funds. We have three excellent guests today. Maximilian Bruckner from 21E6 Capital, Alireza Siadat from Enerton, and Rudolf Siebel from the BVE. I would directly suggest that we start with a quick introduction round, quickly present yourself and also the company or the association you're working for. Who would like to start? Maybe
I can briefly start. My name is Rudolf Siebel. I'm Managing Director at BVI. BVI is the trade association for the TradFi investment fund industry, which currently manages about 4,300 billion, about half of which is institutional funds. The rest is retail. And as you are aware, Germany has changed the law on our partly on behalf of our lobbying, that now our institutional funds can invest up to 20% in native tokens, which would be the equivalent of 400 billion roughly. That's why I'm on this panel today. Thank you.
Thank you, Mr. Siebel. Next, Mr. Siadat, please.
Yeah, hi everyone. It's Alireza here, Alireza Siadat from Enerton. I'm a partner and lawyer from a German-based law firm. We're a boutique law firm focusing on regulatory, and my business is mostly focusing on crypto. So I'm doing crypto advice since 2014, so quite long already. And I'm helping any kind of regulated player, but also startups with their business decision when it's related to the DLT. And today I'm very happy to talk with you about funds and regulation of crypto in that respect. Maybe it's also interesting for those who listen today, besides my activity as a lawyer in a law firm, I'm also very much active when it comes to doing the law or drafting the law. I was for a long time active as an expert with the German Bundestag, helping them to implement the German Anti-Money Laundering Directive 5, and also helping with the new law on electronic securities, which is very interesting when we talk about funds. I'm publishing a commentary on that together with representatives from the German regulator BaFin, but also the German Ministry of Finance. And in the end, also very much interesting, I'm a board member of INATBA, which is the Blockchain Association of the European Commission, where we now help to build up the markets and crypto assets regulation, which is a soon to come regulation for crypto assets, a EU harmonized regulation. And there's also a part where I'm very much active. I was active there since 2 years already, helping to bring up this law. And I have some insights for those who listen today, what this law is going to regulate in the future.
Thank you, Mr. Siadat. Then last, we have Maximilian Bruckner from 21E6.
Yeah, hi everyone. So some of you watching might remember me as being in Christian's seat quite a lot last year, as I was also executive director for ITSA last year. So did a lot of these panels myself. Now I'm with 21E6 Capital. We're a Swiss crypto investment advisor. We do have a strong focus on how to bridge the gap really for professional as well as hopefully soon institutional investors, and what ways they have for safely investing into crypto assets. So we spent a lot of time also researching different crypto funds.
Thank you, Maximilian. So I'm super excited that I have three experts on today's panel again, so that we can discuss crypto funds and everything surrounding regulation and basically what's going on right now on the markets. I would like to start with like a very simple question at the beginning. This would be, why even buy a fund if you could also just buy simply Bitcoin? Like, what's the advantages of just like acquiring like a crypto fund instead of just like, for example, holding like the native tokens of crypto? Who would like to start? Maybe Maximilian?
Sure, yeah, I can have a go. So I think we have to remember that when you're speaking from a personal side, so as an individual, right, it might be an easier and a quicker option to buy Bitcoin yourself, Ethereum yourself, because it's also quite simple, right? You just get whichever exchange you want, Börse Stuttgart or Coinbase or Binance, whatever, and you get going. But as soon as you start talking about larger amounts of money and also managing other people's money, those routes aren't really safe, and they don't really work that well anymore. And you need to start to consider what other options you have. And you do have the options of like buying ETPs certificates and so on. They come, for example, with a certain counterparty risk. And then when you look at funds, the kind of additional value that they offer is the strategies that they run, right? Because when you look at crypto funds, there's a number of different ways these managers invest. There's, for example, long only, long short approaches. There's a number of quantitative approaches. There's also funds now going with market neutral strategies like arbitrage or market making. I think that's one of the big benefits of funds is, first of all, the different strategies you have. And second of all, it's a regulated entity that you can invest in most cases through your normal subscription process that you would, as a professional investor, as a family office, already be quite familiar with, as you've been investing probably into some other funds.
Thank you, Max. Would somebody like to add something to that?
I mean, as mentioned by Maximilian, the traditional advantages of fund supply. Obviously, there's also the additional costs involved of having a layer of regulation and a layer of product. But it's important to understand that institutional investors especially need an additional level of safety, assuming that they are allowed to invest in, which Alireza might talk about in a minute. But think about a 150 million euro strong pension fund for veterinarians in Eastern Saxony, which has a two-man capital investment team. And suddenly, because all these doctors become interested in Bitcoin, they get asked to invest 5 million in Bitcoin. Then the shit hits the fan. Those poor guys then have to make exactly the choices Maximilian is saying. And then obviously they would in the first place resort to something which they are familiar with, which would point to regulated funds, even which have a accepted value chain from research over portfolio management, over trading, over post-trade, and maybe later on, assuming also that the market is developing, would pick up on direct investments. Certainly the bad news we see all the time on that so-called crypto exchanges get hacked, or other partners in that area, like the 500 million loss 10 days ago, is not helping that the poor guy at an institutional investor who has to make the investment decision on behalf of the pensioners will jump into that. That's simply different if it's your own private money, and maybe in that space also not your main investment, but maybe just, as we say in German, Spielgeld.
So maybe I can also add something from a regulatory perspective, in addition to what Max and Rudolf already said. So if you look from the regulatory perspective on doing an investment, of course, you can also get an advisor to yourself who helps you to do the investment, which would be an investment advisor. This would not be a fund manager, but then it would be only yourself who's doing the investment. You can also ask the investment advisor to put a portfolio for you together, then it would be put portfolio manager for you. But this again would be only yourself doing the investment. And it has two negative sides. If you go alone and do your investment, even though you have your investment advisor next to you, that your investment is small. And if the investment is small, your advisor maybe does not have that much push to do the best investment for you. Is not that strongly regulated, rather than doing that for a big group, for cash pooled of a fund. And the other side, the target side, there are some targets like startups who do in soft, where you can only do an investment if you have a certain ticket size. So you cannot invest with, like, let's say 1,000 or 10,000 euro. The ticket size is maybe 500,000 euro upwards. And in that case, it is maybe interesting to be in a group of investors. So to have a fund manager with you and to do the investment for a fund, because then you have both positive sides. You have a regulated fund manager which has a strategy, an investment strategy, someone who is regulated. I mean, they can, for example, call BlackRock as one of the main fund managers nowadays. And then you do an investment in some diversified portfolio of different targets, and one of the targets may be something where you can only get in if you reach a specific ticket, and then it becomes very interesting, as Rudolf said, for the bigger investors, who for the institutional investors who mostly go into a fund investment rather than getting an investment advisor or portfolio manager and helping them to do some single investment.
Thank you. Yeah, I think we had some really interesting like changes this year, or let's say like last year, that now fund managers are able to allocate up to 20% into cryptocurrencies. So I would really like to know from you whether you think that's the first good step, and basically what's the outlook for the future on that.
Yeah, I mean, from a regulated fund manager's perspective, so a fund management company under AIFMD or UCITS in EU parlance, or KIGB in Germany, obviously this is a very positive step. I mean, the first step actually is that we had the EWPHG, which gave up on the requirement to have still a paper certificate somewhere in Clearstream. So we have now digital securities, which are account-based only. And the same law provided also for tokenized securities. So I think in layman's term, there's still a prospectus. It's still a Wertpapier, you know that, but it comes in tokenized form. And there, obviously, the lawmaker said that could be possible both in the form of a bond. Usually, we see it as a certificate, as Ali Reza said, or as a fund unit. And the fund unit requires special implementing regulation, so-called Kryptofondsverordnung, which is just about to be published until June. It has just passed an EU test for conformity with EU law. Ali Reza mentioned that there is EU law also in the making. So that would, but unfortunately not equities. There you still need to go maybe to foreign vehicles. That has to do, I think, with German traditional law focus in equities, and also maybe issues like organizing a AGM, a corporate shareholders meeting, and how to bring that together with tokenization. I personally don't see these risks, but there seems to be, there was some resistance in that area. And separately of that, we introduced, with the help of others, as a sort of test case in institutional funds only, to reduce any debate on investor protection, because institutional investors are more sophisticated, a 20% limit on investment in native tokens, not securities tokens. That comes anyway, it would be possible, but in native tokens like NFTs, for example, or Bitcoin, in the German law, just for institutional funds, so-called Spezialfonds. So you have two main streams. One is the investment side of a fund, which could now go 20% in an institutional fund into native tokens. And on the other side, you have the so-called passive side, the side, what do you buy as investor? That's the fund unit, and that can be tokenized also from, I guess, potentially June on. And you have just seen yesterday the announcement by one of our members, MEAG, together with BNP and others, that they have finalized a proof of concept to be able to then on blockchain actually trade these fund units. So both sides will be in place. Maybe just to finish off on the retail side, as mentioned, for investor protection issues, but also because that comes under the sovereignty of the EU, i.e. the UCITS directive. We could not introduce a crypto investment possibility into retail funds, at least not UCITS funds. So there we would be waiting for the EU to introduce that, and they will be probably doing something like that after already Ali Reza mentioned it, the basic blockchain regulation in the form of MiCA has been passed.
Mm-hmm. Thank you. Would somebody like to add something to that? Otherwise, my next question would be already, now that it is possible in theory to allocate 20% in like crypto assets, what's a little bit like the reality? Maybe Max, do you have maybe already seen some changes, whether like people have now requested more crypto investment, or whether they are still a bit reluctant of basically adding cryptocurrencies to the portfolio? Do you have a take on that?
Yeah, I mean, I think, again, for this question, we need to consider whose perspective we're seeing. So if we look at or kind of what priorities we have when investing in crypto, right? Like some people might be investing in crypto because they really just want those massive returns, and they don't really care about the volatility or the drawdowns, because they say, well, I'm in it for the long run and I'm fine with taking it. And then for them, like 20%, they probably would want to invest more than 20%. But I think from a more professional side, institutional side, and for me, we spend most of our time really talking to family offices. A much smaller allocation makes sense for them because they want to keep the volatility and drawdowns relatively low. And so we say from some, studies we've done, and also there was a study done by Yale a number of years ago, that usually up to 4 up to 6% of crypto allocation makes sense when we look at your portfolio performance and kind of your risk-adjusted returns, which are a key metric here. And once you go above that, so like 10%, 20%, 30%, we really see crypto taking over the portfolio in some sense, because the scale of cryptocurrencies in their performance is so different and so much larger than the scale of, like, let's say, global equities, right? I mean, crypto is moving at returns of 100, 200% annualized returns, global equities much less. Hence, volatility is also much bigger in cryptocurrency. So, and so when speaking to these family offices, yes, there is certainly interest, either from them or a lot of times from their clients to invest in cryptocurrencies. And then, as Rudolf said, we have the issue of like, okay, my clients want to invest. What do? I don't really know anything about it, right? But they are quite careful. So most of them don't go actually anywhere near those 20%, at least, even though I think probably they could.
I mean, on the regulated funds, we clearly have seen one example only, which was publicized, which was 2 weeks ago. Our member Hansa Invest announcing that they had a dedicated fund in that area, which will be then supplementing other institutional investments. We see still the reluctance by regulated investors under insurance laws in the widest form, which are insurance companies directly, as well as pension funds or other institutions of occupational employment, which might come under direct regulation or just apply it. But which usually would wait for clarification from the regulatory bodies in that area that direct crypto investments is allowed going forward. So unfortunately, that large chunk of the market is pretty inaccessible at this stage, I would say. Maximilian clearly mentioned the family offices and maybe corporates. These would be investors which do not have to fulfill certain regulatory obligations when it comes to their own investments. Foundations are a little bit different because they still have to apply the aspect of security and safety first, and that might not be possible. So we simply see that a large group of the potential investor base cannot really, according to laws governing their own investments, go directly. And for the unregulated in that form investors, they are more, I think, on the way, as Maximilian said, tipping their toe into the hopefully warm water and get more accustomed to investing in tokens. So we as BVI have not yet expanded our statistics, because it's sort of difficult to show on a bar chart less than 1 billion or less than 4 billion in comparison to 4,400 billion. But we are certainly considering expanding our statistics for next year to be able to monitor a little bit more that in part of the investment. But I truly believe it's a medium to long-term thing before we really see that visible parts of the 400 billion are invested in native tokens. It might be different for the securitized tokens. I mean, you have also seen that our member Union Investment participated in the EIB bond of 100 million. That is a classic bond, classic issuer, highly rated, classic documentation, I would say, Ali Reza. But the new thing was, it was not a traditional SWIFT type investment, but it was through the blockchain. But it took my member 2 weeks to set up the relevant additional value chain within its own organization to be able to support that. So that needs to be nourished by more investment. So we are calling on Bundesbank, especially, and the US Treasury to issue government bonds, at least partially in tokenized form, like they are doing green bonds now, because that would raise the level of acceptance very much and very quickly, because people then would have a very liquid, comfortable investment they are comfortable with, and they would just have to think about, quote unquote, the technical issues related to DLT. Unfortunately, as you all know, because of the central bank digital coin debate, which we also need to pay for the token on chain. We see still a reluctance to go in that way. And that's, I think, one of the main hindrances, at least for traditional investors in government bonds, to look for tokenized investments too.
Yeah, so maybe I can also add something from a regulatory perspective. So as I said, I'm quite long in the market, and we talked to pension funds a couple of years ago, and they have the need from the commercial perspective to do some other alternative investments, because nowadays the investments they do on a long term from a strategic perspective, they're not really helping them from a commercial perspective. So they need some other investments where they can gain more interest. However, what we understand is that the lack of transparency when it comes to regulation was a big showstopper. This is changing now. This has changed a lot since 2020. So we have new laws coming in, new laws giving guidance on how to do an investment and what is allowed, what is not allowed. But what is also missing, what most people do not really have on their agenda, is a proper infrastructure. A proper infrastructure, let's put it in the investment language, you have the investment triangle. So you have an investment manager, you have the investor, and you have a custodian. So for a long time, it was not clear if the traditional custodian is allowed to also custody crypto assets. This became only in the near past clear. So as you can see in this example, which Rudolf gave us with BNP Paribas, MEAC, and Ergo Group, that they have built up a new kind of investment triangle. But in this investment triangle, what was also missing was also an IT solution for this kind of investments. So IT solution like funds on chain is bringing now into the market is something you really need to do an investment into crypto assets. Because if you do an investment in crypto assets, what many people don't get is that you would acquire a token, and a token cannot be custodied by the traditional custodian. So you would need someone who has the technical background, the technical understanding, and you need the APIs to the traditional infrastructure which you have. So you need all of this infrastructure before you can do really a tokenized project. And this is, I think, what is now coming. So there are service providers in the market who are now prepared, who know how the law will look like in the next month, and who are now bringing in some services and some technical solutions which will help to do such things.
Indeed, that was my reference to the Union case, where everything was made by hand, quote unquote. So certainly this example is also, and just sorry, Maximilian, to close off the advertising block, but I'm required to mention my member Universal Enlight too, who want to offer things like that. But let's keep it in.
No, thank you. No, I think right now there was like a lot of things that that basically are new to the market, and I'm also very excited about that. Now traditional players have basically entered also the market for security tokens. I think last year Maximilian and me, we were still classifying security tokens, especially like worldwide, and our findings were a little bit that security tokens were like massively issued in the years 2019 and also at the beginning of 2020. And then due to uncertainty in regard to regulation, we saw a major dip basically in the end of 2020 and 2021. And I think now recently again, we could basically see that they are now catching up again. And yeah, I think we also spoke a little bit about hard stocks before this call had basically started. Mr. Siadat, could you maybe give some details on what's so special about them?
Yeah, so before I do that, maybe to give to those who listen a little bit background, because what Rudolf said a couple of times, maybe it's not clear to everyone. So a traditional fund or fund manager can invest in crypto assets, which are cryptocurrencies and NFTs, up to 20% of its portfolio. But for traditional securities like MiFID securities, this 20% threshold does not count, because if you have a traditional MiFID security, you can invest in it open-end. So, and this is very interesting because we have crypto securities or securities like from an STO, which would fall under the qualification of a MiFID security, and then an investment fund manager could invest in it without thinking about the thresholds. But to have something like this, you need to have a couple of requirements. You need to have a security under MiFID, so it means it is a fungible instrument. So an NFT, for example, can never be MiFID financial instrument because it is non-fungible. And fungible means it's standardized and it's freely tradable. And standardized or standardization for the tech people now listening, standardized means ERC20 is standardized, but ERC 721 or 1155 is not standardized. That's why it's used for non-fungible token. So non-fungible token would be already out of the picture. So you would need to have an instrument which is similar to a share of a company where maybe you have voting rights and maybe also not, but at least where you have dividends or a claim to dividends, interest. So this product, you would also need to have a prospectus. So prospectus is something where a regulator within the European Economic Area is accepting this documentation, the prospectus, and then you're allowed to freely distribute your security token within the European Economic Area. So this is a second thing. And the third thing, which is interesting also for an investment manager, that your security token is traded on a liquid market, or at least a market which is close to have liquidity. And this is something you can only build up infrastructure where people are dealing with such instruments. And Hardstocks has done something like this. Hardstocks is a startup from Liechtenstein in Germany, which has taken the Liechtenstein law, the Liechtenstein Blockchain Act, allows you to put any non-bankable asset, such as an old timer, inside a company like a Liechtenstein AG, a corporate stock corporate entity, put this entity inside this asset inside the entity, and take the shares of that entity and tokenize the shares, and then put that shares into a securities prospectus, and then passport it to the European Economic Area, to Germany. And this is what Hardstocks did actually. They have the product, which is an old timer. They put it into a Liechtenstein company. They took the shares of that company, they tokenized it, they put it into a prospectus, showed it to the Liechtenstein FMA, which then agreed to that. They did the passporting to Germany, and they are now distributing this product in Germany with a bank like Bankhaus von der Heid, with a market maker, Bankhaus Scheich, with a custodian of this crypto assets, which is again Bankhaus von der Heid, and an umbrella which gives the company of Hardstocks the possibility to act as a tied agent, which is Concedos. And this is close to have a marketplace or market for this kind of instruments. And now we're just looking to get some exchanges also being onboarded into this infrastructure, and then we have a nice market for securitized products.
Because fully agree, Ali Reza. The only part which is taken also some more prominence besides the liquidity of the investment is that BaFin is very strict on risk management procedures. So you have to show that you know the investment, i.e. have to qualify from your management directors downwards a certain amount of people, and as well show them that you have a specific risk management process on top of your investment risk management process, which is able to identify and manage the risks specifically associated with a token investment. But otherwise, fully.
Because like this was for me always like I got super excited. I know like 2-3 years ago when I was the first time reading about security tokens, because like the implications for also small and medium-sized companies who were often not having the proper access to like to the financial markets, and that was always something where I was like super excited about. But then I realized, well, the secondary market is still very much an issue, and like the liquidity and everything. And I feel right now we are slowly but steadily moving into the right direction in regard to that.
But actually one last question to Ali Reza on that part. You mentioned that this particular scheme you mentioned is trying to open up by adding additional exchanges. Do you already see that we need the tipping point that all the protocols can talk to each other? Because one thing which we are fearing, especially on the fund distribution side, i.e. the fund processing side, like the MEAG example. I mean, if MEAG is having their own chain solution, Fidelity is having their own, you mentioned BlackRock. So let's say the larger companies do that, we will have an even worse situation than we have today with TradFi, where at least all the investment advisors and all the banks can, in theory, at least access all TradFi funds. It would be obviously very harmful if each fund provider or the larger ones would have all their own solutions, because then in the end, the investors would not want to deal with such a fragmented market.
Yeah, you're absolutely right, Rudolf. And this is actually a question coming from someone who's into the market, because many people that do not think about the small details, which are in the end very crucial if you want to plan something on a on a long run. And what I see nowadays, you already have to make the decision on which blockchain standard you're going to issue your token. For instance, there are some who are in the NFT sphere active who have issued their NFT on the Flow blockchain. However, the Flow blockchain does not really have a marketplace. You cannot really do the trading between the wallets. And this is why Flow blockchain is not really that interesting. Others have chosen in the past Ethereum. However, Ethereum has crazy gas fees, which are too expensive. And therefore, Ethereum is also now in the change from going proof of work to proof of stake, and maybe it becomes then cheaper. But I'm absolutely with you, Rudolf. Once you build up the infrastructure and also looking to the secondary market where people are interacting with each other, we need to agree to some standards, and standards start with the blockchain standard. Also important for the custodians, which standard they use and follow, and then also look at the technology they use. I would call it in the banking sphere the core banking system, and here it's going to be like a crypto trading core system, which they need to use, and we all agree to use it. And this makes it possible for all the participants to interact together.
Mm-hmm. Great. Then I would just shift to another question, which goes, I think, more into direction of Maximilian. What I would really like to know is, like, I think you have a good picture of, like, the global perspective on crypto funds, like which countries are basically maybe a bit ahead of us, which maybe are a bit lacking behind. Is it the USA, Europe, Switzerland, Singapore? Like what are like the predominant names worldwide at this moment in regard to crypto funds? Like basically who's leading this field at the moment?
I think very interesting point to look at the kind of entire crypto fund universe a little bit and where it's coming from and where it's going. So if we compare it to the AUM that Rudolf, for example, talks about, I mean, it's small, right? The cumulative AUM of the entire crypto fund universe is like, I think, between 60 and 70 billion US dollars right now. And that's far removed from the 400 billion that Rudolf Siebel would be talking about. But what's interesting is that it is in fact growing, and every year there are more new funds opening than closing. So I think that's generally a good sign. When it comes to the areas they're in, we see a lot of fund, kind of the teams that are managing the fund oftentimes come from the USA. So either they're sitting there or they are quite decentralized. A lot of times it's the teams are a combination of people from the traditional space. Maybe they've run a hedge fund or did asset management before. Then they've joined a team of kind of crypto natives and they're doing something together. But the actual domicile of the hedge funds that are doing this is mostly Cayman Islands and British Virgin Islands. I think between 40 and 50% are there. Then we see some in Switzerland and some also in the USA. But really, for example, Germany, not a lot going on in that regard. Switzerland, yes. And now I think Liechtenstein as well has some interesting issues. And I think Luxembourg will become interesting now that they've started to open up as well, because of the whole theme of how to get into the EU and passporting, right? That's quite easy from Luxembourg. So once they open up the regulation, I think that might become a hotspot quite quickly. But for now, like I said, lots of US-based managers with their funds domiciled in the Cayman Islands and the BVI.
Mm-hmm. It's very interesting because, like, we have one listener called Andreas von Richter, and he was very quick with when I was basically asking the question. He instantly wrote like Cayman Islands. So we certainly have we certainly also have some expert in the audience. And yeah, thank you, Max, for the answer. And then
I don't want to be nasty, but we don't want to go to Cayman Islands. And I was asking the question with Binance. I mean, Abu Dhabi or Bahrain is all fine, but it is not something a German-based insurance company or pension fund would do.
Mm-hmm. Yeah, I know it's like basically like a bit of a, I wouldn't say like gray area, but certainly not like the full regulation as like most fund manager would like basically pursue, right?
I mean, I was just waiting for that, Rudolf, because as a lawyer, I don't want to make too much commercial for Europe and for Germany. But I've seen the market since 2014. I've seen lots of things which may have come up. And lots of these things have failed for the simple reason because a lack of regulation. And I'm not a big fan of regulation, but if you if you need regulation for transparency reasons and for security reasons, for risk reasons, then regulation is good. And you can see it now in the German market, not especially on a fund market, investment market, but on the banking market, on a custodian market. There's a reason why Coinbase has chosen to come to Germany and has applied and received the first license as a market maker and a custodian in Germany and not in any other jurisdiction. There's a reason why BitMEX tried to acquire Bankhaus von der Heydt. There's a reason why BCP Group is trying to acquire Suter Bank, because in Germany we have transparent regulation, which helps for a market which is mature and which is professional to work. Yeah, and I have lots of clients coming to me and asking me, should we go to BVI? Should we go to Cayman? Should we go to Dubai? I'm telling them, yes, if you want to do quick money and something quick, do it. But from a strategic perspective, if you want to have from a strategic perspective, this will not help you. I've seen lots of clients which started in BVI or Caymans and now have problems with their banks accepting those monies coming in, because the banks, they say there's a red flag if you come from BVI or Cayman, because we do not accept it. This is from a tax perspective, this is from a risk perspective, and from other perspectives, not professional.
Anti-money laundering and so on. I'm not saying that these are bad locations and they all try their best. Those we mentioned are also not on the FATF list, for example, to make that very clear. But as Ali Reza clearly said, there is a level, at least a level of perception of institutional safety, which is a clear difference between us and them.
So I mean, I think you have to consider again, right, what the target audience, let's say, for those funds is. I mean, those on the Cayman Islands, right, they are hedge funds, and I mean, even quote unquote normal hedge funds, most by far, I think the majority of them are also offshore on the Cayman Islands, right, because of tax reasons. So that's from that perspective. And also we mustn't forget that the crypto fund market in its state now, it's very, very top heavy. Most of the AUM is managed by like 5 or 6 funds, which have been around since like 2013, 2014. And of course, back then there was really nowhere else to go also, right? What should they have done instead? So that's why they're sitting there managing their billions. And I think, Ali Reza, to comment on your perspective as well, I think most of the crypto market, and especially big exchanges, they are not running away from regulation. They want to be compliant because they know that's the only way they're going to be able to work in the future with the institutional counterparties that they want to have.
Yeah, this was something interesting also what I observed like last year. I mean, maybe a little bit different topic, but maybe still somewhat like similar. We saw like this SEC lawsuit against Coinbase when they started to have the offering regarding the yield on the USDC stablecoin, and Coinbase was super compliant, and they basically changed all like cash equivalents to cash within like a couple of months, just basically to follow regulation, because this is also what I basically observed, that basically these companies in the crypto space are really dedicated to basically comply with the regulation that has been like basically decided in the past months or years. Yeah. And let's get a bit back about like a bit more technical maybe, but we could see basically in the past that Bitcoin was mostly not so closely correlated to the stock prices actually. Maybe also a bit more in your direction, Max. This has now changed a little bit, I would say, in the past 3-4 months. We could also see that there's a lot of money from institutional flowing in. Yeah, has Bitcoin changed a bit? And basically, yeah, is the correlation now something good, something bad? Do you have a take on that?
I think especially the past 2-3 months I don't think we should see them as a sign that the correlation is increasing, because it has been at times of crisis, right? The conflict in Russia and Ukraine area, also COVID, like an ongoing thing. And in times of crisis, correlations go up across all asset classes, stocks, bonds, gold, even, right? Commodities, kind of the correlation rises. So, and when we look at crypto or Bitcoin, let's say correlation to stock markets, it's important to not look at static correlation, but to look at it on a rolling basis, because then we can see that it actually fluctuates quite largely, usually from around negative 0.5, so from a negative correlation even to a positive correlation. And right now, probably there is somewhat of a positive correlation due to the recent crisis we encountered, also when the big part of that coronavirus crisis hit, there was also a massive correlation there, which then kind of dissipated again. So that's the key. I think it's not correlated, at least over a rolling time frame and over the long term. So kind of taking these momentary snapshots of right now when talking about crypto correlation to stock markets isn't really the right approach. We need to have a broader view.
Mm-hmm. And then maybe a bit specific question to Mr. Theadat. I'm not sure whether you would like to answer it. You can gladly say no. But for me, it was super interesting to follow up what was happening in the United States with like these Bitcoin ETFs, where basically they were never really admitted by the SEC, and this is already now going on for like months. And basically now I've like recently heard that also Grayscale is even thinking about having a lawsuit against the SEC if they would not admit it. Do you have an opinion on that?
I mean, I have to be careful because I'm not a US counsel, I'm not a US-based lawyer, so I'm not really knowledgeable with US crypto law. But this is what I'm trying to say during the whole webinar already, that a transparent, good regulation helps the entire market. And what the US is doing, the SEC or the FinCEN is doing, they're not giving proper guidance on regulation. I mean, they have the Howey test, and they have some other things which are very complex and no one really understands. Plus, they have different state law. Like in Wyoming, they have a different law than in New York State and other states. And therefore, it is very, very complex. And this is also what we see now in the EU markets, that many EU issuers, they exclude US investors because they do not really understand how US crypto or finance law works. Plus, the consequences, if you're not compliant with the US investment law, they're very harsh, and they can hit you quite tough, and therefore it is tricky. And this is also the reason why you see also US players like Van Eck and others who set up their products and they set up maybe in the EU because there is some guidance and there is some understanding on how to deal with it. And this is as much as I can say towards that. I cannot really tell you if SEC is right or wrong. I can't really tell you because I'm not a US lawyer, but I can tell you that this is exactly the reason why you need transparent regulation. And this is also the reason to finish up why DM or Libra was first coming from the US to Switzerland or to the EU and trying to kick off their product here, because here you have an environment which is not really 100% crypto friendly, but at least transparent when it comes to regulation and tells you exactly what you need to do to be compliant. And this is also the reason why many players, they choose the European environment for kicking off their crypto projects.
Mm-hmm. So
in the end, I mean, I fully agree with Alireza. In the end, it's are you fitting? If you are issuing a security, you are not in the free market, you are in a regulated business. And according to the SEC, and that was just confirmed by Mr. Gensler again, I think yesterday, where he encouraged crypto players to register under the SEC, quite often, at least from their view, you are stepping into the area of regulated investments, securities, funds, or direct. And then you should better register. And I think at that point, the SEC will not give up.
Mm-hmm. Actually, we just got a question from the audience. Ulrich Deichsel has written to us and he says, "Hi guys, first of all, I might be wrong, but isn't it more than 95% of all the money invested in crypto coming from outside Germany? Also, 95% of all crypto tokens and coins are managed outside of Germany. Therefore, shouldn't we simply follow the leading countries regarding regulation and fund setup?"
Yeah, that what we already addressed. I mean,
yeah.
I'm sorry, is Liechtenstein, Caymans, Bahrain a leading country? No. I mean, at least not if you want to address German institutional or larger investors. I mean, yes, you can peddle around with 50,000 from Mr. Siebel and maybe more from you. But if you really want to go for the 400 billion, we have now secured in the law, and I'm saying we're only at $1 billion. If you want to go for the 400 billion, you should build up the infrastructure. Alireza has perfectly described that along the value chain under a OECD or G7 country regulation, because then you can do it it might take more time, a little bit more effort, certainly more cost, but then you are at least equipped to play in competition with the traditional TradFi institutions.
Mm-hmm. No, I have to say I see it very similar because like my background is economics, finance, so all this regulation topics is still something new to me from time to time. But I also see it this way, that it's very important that we like as like Germany or like European area really have like competitive laws which really like encourage like the safe handling of these assets and basically also the creation of these crypto funds. And from that, actually, I would like to maybe quickly touch on a very, very new topic. I think we've also shortly discussed it before a call. Enzyme. They claim to be a crypto on-chain fund, or let's say they help to create crypto on-chain funds. You can basically decide on your allocations. You can, for example, say, hey, I want to have 30% Bitcoin, 30% Ethereum, and the rest maybe some LP tokens. Is this something that, like, first of all, how will likely regulators have a view on that? And then also, will it be even accepted by the market, or will it really be like it is now, that like the traditional funds will still dominate?
I can only say that it is not a fund regulated under the KAGB, nor it is a fund management company regulated under the KAGB. To me, it sounds like schemes in TradFi enabling so-called social investing types, which is a good thing for active investors to be able to join up with other active investors. So I'm not against this kind of scheme, but I would leave it to Ali Reza if you want to give more a legal perspective where such schemes stand, because that's outside the BVI scope.
Yeah, thank you, Rudolf. So I agree with you, but from a legal perspective, this kind of platform, it's in the end of the day, it's pretending to be a DAO, a decentralized autonomous organization, and they're all pretending to be a DAO because they say we do not have an intermediary, we do not have an obligated party which must comply with the law, which must comply with the fund law, which must comply with the banking or securities law, and this is what they all try to achieve. So far, we do not have a common understanding on how to regulate the DAO, but there is a move towards really looking at the platform and looking at it and saying, is it really a decentralized autonomous organization? Or isn't it really that someone who's running the web page or someone who has a majority of the votes, of the coins, is the one who is having control over that platform? And then it's not really a decentralized autonomous organization, but in the end, it is run by some people who also get interest, like commercial interest from that platform, who should usually also comply with the law. And I believe that most of these platforms, they bring together the parties, they bring together the participants, and in the end of the day, this bringing together the parties who then will buy or sell financial instruments, it may be some kind of brokerage business, and this brokerage business usually needs a license and usually needs someone who's getting the license. And there's also some reason behind it why you should need that, because if something goes wrong, who's liable in the end of the day? I mean, as long as everything is fine, as long as we have the bull market and everything is earning money, no one is complaining. But as soon as something goes wrong, we saw it on OpenSea, who's pretending to be a DAO. We saw it there that someone was selling like a fake NFT and someone else bought it, and then there was a massive fraud. And then people are asking, okay, isn't OpenSea really having the data of the people, and why didn't they do a KYC? Why can't they tell me who was the seller of the NFT and stuff like that? And you will see the same on Enzyme. You will see the first people who follow some structure, and maybe it is a strategical structure by people who do a Ponzi scheme, like this pump and dump schemes you see nowadays also on Telegram and other places, where they really pump some investment strategy just to benefit themselves, and then everything flops out. And who's then taking care of that? There is no market abuse regulation. There's no market abuse directives. There's nothing in this market who helps the investors. And this is something everyone has to be clear about that. And this is where the regulator jumps in and says, okay, look at this player, look at this player. We just want to make sure that you understand these players are not regulated. If you invest there, you take lots of risk, but if you're up for taking the risk, go for it.
Thank you for that answer. Yeah, it's very interesting because it somewhat connects to the panel discussion we had last month, which was about DAOs, and there we also figured out that Yeah, I mean, many DAOs claim they are a DAO, but in fact, many are not autonomous because, like, for autonomous, first of all, you need this kind of on-chain governance and not these kind of snapshot votes, which are still basically handled by the developers. And then second, it's also like this question of like, how are the votes distributed? Because in the panel from last month, we have also figured that there's many semi-dictatorships or dictatorships, which refers to that there's like a bunch of people basically controlling the entire protocol, and sometimes even with a threshold that even if these token holders don't vote at all, there cannot be any vote passed. So yeah, this is something that we at ICSA also very look closely at, and that we always like to follow up on, but we also see it a bit critical. Great, then I would suggest that we ask Maximilian one more time also about like general like drawdowns, volatility, maybe a bit more like in the final section now. What's like the average performance there like for like crypto funds, especially also when you add some of the crypto basically to the fund allocations. Do you have any observations?
Yeah, so there's a big discrepancy, first of all, in crypto funds depending on which strategy you wish to go for. So it's a fact that a lot of the kind of directional alpha and beta capturing funds, they do outperform Bitcoin a lot of times, but they also have a higher volatility actually and higher drawdowns. So like if we're talking about a fund that has like, I don't know, in the last year did 200% or something returns, and they also had like a huge volatility that is going to be unattractive for a lot of investors, like right off the bat. Then on the other side of the spectrum, you have these, like I said earlier, market neutral funds. They are doing like maybe 10%, maybe 8%, 7% returns, but then their volatility and drawdowns are extremely low. So they also have a really good Sharpe ratio, right? Risk adjusted returns. And that's kind of the key when we look at these crypto funds and why we say, hey, adding crypto to your portfolio makes sense is because of this exact ratio of returns to risk that they provide. So they usually, even if we just take Bitcoin and we downscale it so that we can compare it well to global equities and other investments, they usually have double the risk adjusted returns to what we see when, let's say, we take an MSCI World. So that's why it makes sense to add these crypto assets to your portfolio, because I think, first of all, there's a consensus in the market that it's here to stay, right? So you're not really taking a huge risk in that regard. Maybe you say, well, a reputational risk is kind of an issue. Okay, leave that there. But if you look at it from a pure perspective of, hey, how do I optimize my portfolio? And even when you say, I want a diversified portfolio, then I think we are at a stage where crypto assets cannot be missing from your portfolio, because they are part of a diversification. We had it before. They are not correlated with the stock market, at least in normal times, not in times of crisis. And they significantly boost your performance. Like when we did a simulation, very, very simple. Take a standard kind of family offices portfolio, which is doing like, let's say 60% equities, so 60% like global stocks, 30% bonds, and then 10% in like some alternative stuff. And you say, okay, what happens if I just add like 2% super naive crypto, like Bitcoin, Ethereum, Uniswap or something, 2%, and you see that the returns will go up significantly by like, I think in our example, it was they went up by 3%, the annualized returns, but the volatility and the drawdowns moved by less than 1%. And then, okay, now your risk-adjusted returns improve. Now, what happens if I add 4%? You see a similar thing. And then only when you get to 6, 7, 8, 9, 10% crypto allocation, you see an issue with the downside protection of your portfolio. But before that, really all it does is improve your performance. And let's be honest, a 1% position on your portfolio does not prove as a massive risk to your entire portfolio, no matter what it is in.
Mm-hmm. And I think it's like a great entry point, right? I mean, you don't have right away to start with like 10 or 15% allocations. I think crypto is very much about trying out, right? It's like a totally new space, and there's also something that I've realized, like you often talk about crypto, but sometimes it's really about like going on MetaMask, like log in, go to the different sites, read up, and just do things and basically make your own experience, right? This is something that I've really learned over the past 2 years, I have to say. And actually, we got a question again from Andreas von Richter towards Alireza. and he asks how much capital is flowing into Ponzi schemes versus total market cap of crypto. I know that's a very specific question. Do you maybe have an answer for Andreas?
No, I do not have an answer. I assume that there are not much answers on that. You can follow the FATF publications because the FATF, they give really nice publications on crypto. And you can also follow what BaFin says. But I believe I understand where this question is going to say that the Ponzi schemes within crypto, they are not that much compared to the whole market, which may be true. But once something like this happens, once you have a Ponzi scheme, the voice is loud, and the voice is much louder than when the most of the people they're gaining profits with it. And this is something when it comes to the retail market. So this enzyme, for example, this enzyme crypto is targeting the retail market. So if something is targeting the retail market, even if it's only hits one single person, we have to watch out and have to be careful because even if it hits one single person, let's say a grandma who's putting all her investments there through her niece or some young family member who says, give me your money, I'm going to invest it for you, and it looks very great. So what happens then? So and if this goes wrong, this is exactly the point when everyone is becoming loud and screaming out and saying, why didn't the German authorities didn't interfere and do something? And this is why even if it's only 1 or 2 cases per year, this is 1 or 2 cases too much.
That's why you see this discussion yet now on the EU level with unhosted wallets limited to 1,000 euros. Mm-hmm. That is then the fallout. I mean, the more such cases happen, I mean, if you compare it to traditional banking, simply these outright cases of fraud are not existing in that form on traditional banking. There may be still cases of fraud in advisory situations, but usually this is the so-called, Ali Reza can confirm that, on the so-called gray market, grauer Kapitalmarkt in Germany, which has been largely also curtailed through Vermögensanlagegesetz and other rules in the past. Trust is a matter which is not divisible. And if we need trust, and especially in the retail situation with Verbraucherschutz, protection of retail investors arguments, essentially there should be 0 cases. And you cannot have cases of 500 million like 10 days ago, and then everybody walks away and says, well, it's only 500 million. I mean, that's a disaster. In trust terms, in acceptance terms, it's a disaster. That's just not a market, that's a scam. And that will totally destroy trust and will certainly not bring general retail investor base, which has not been focused on crypto so far, nor institutional investors into that market. These things really need to stop. And that's why Ali Reza is totally correct. We need market abuse regulations and things like that applying in that area too.
Yeah, I mean, there was also recently like a Netflix documentary published about the ongoings in crypto, which was also not always in favor, but I can recommend it to everybody, also to the audience, if you haven't watched it yet. It's very interesting to watch for sure. And then I would suggest, because we're already almost at the end of our panel now, that I have a final question directed to all 3 of you guys. Because ESG was always like one of the hottest topics in the space of crypto. Sorry, not in the space of crypto, in the fund management world. And Bitcoin, yeah, it's a bit difficult, right? Because some people say it's very bad for the environment. Others say, well, there's a quite high amount of renewables already used for it. Others say, hey, we have the RGG as well for governance, right? This is also something we should always consider. So what's your take on basically crypto funds, Bitcoin, and ESG?
I mean, for regulated funds, at a minimum, all funds have to consider ESG aspects of all their investments and the risk of these aspects towards their investment objective. So in that sense, obviously, to the extent that arguably a fund would invest, a retail fund under a certificate in Bitcoin or institutional funds under 20%, they should be considering also the ESG risk, and that is done. Obviously, if the fund has a dedicated ESG strategy, and we don't go into the details here, it might be more difficult, but that definitely need to discuss it. It is discussed, and obviously there is the energy aspect, and there are various studies going in both directions, saying that the energy aspect may be reduced or will be reduced through change of the proof system. That's one aspect. Or you go to volcanic or Icelandic water and energy to use green energies only. So all these aspects need to be considered. I think for our members, like any other ESG investment, the question is, do we get the basic data? I.e., in this case, for example, which energy is actually used for mining and trading purposes? From which sources do we have these different carbon dioxide levels and then can we continue to invest that? But obviously, it's this discussion is a stumbling block, at least for ESG funds of all kinds, to primarily go into crypto. So in that sense, it's certainly not helpful. On the other hand, this is an industry driven by very young people who are usually also pretty much focused on climate issues and so on. So I totally believe that within the industry, there's a strong wish to make it as ESG compliant and also as carbon neutral as possible. But again, this is at the beginning, I would say.
Yeah, I agree. And I think one of the big, benefits of, let's use Bitcoin or whatever crypto assets you want to invest in when comparing it on the level of, okay, how ESG compliant am I in my fund, is that it's in a way quantifiable. Like, right, it's transparent, you have the data, so you are able to find out what is actually the, let's say, carbon footprint, at least on the E perspective of however many Bitcoins I'm holding or how many transactions I'm doing. There was a study by the Frankfurt School Blockchain Center on it, for example, as well. So it's quantifiable. And I think that's a big, very helpful step, because then you know, okay, what is the impact of this part of my investment? And then you can see what else is in your fund and kind of how is the balance then, right? Whereas I think a big topic for a lot of these ESG funds, is still figuring out how do I actually quantify and know how ESG compliant any of my investments are. Like, do I put it on a number scale, or do I have it like on my refrigerator, A, B, C, D, E, F, G, kind of like, how do I put in numbers, and then how do I actually calculate and figure out how much I can allocate where in order to have the compliance or have the considerations that I want. And for blockchain, at least in theory, with the data we have and the immutability and the transparency, it should be possible to quantify it quite well. So I think that's a big benefit we have there that's maybe not quite fully used or understood yet.
Yeah, maybe I do the final catch up. So I would follow what Rudolf said, and this is very important. Bitcoin is not environmental dangerous. Bitcoin has a high energy consumption, such as any proof of work coin has. So we as the users have to figure out how to make the use of Bitcoin, or better to say, the mining of Bitcoin environmentally friendly. And this is where I can say we're not doing enough in Germany or within the European Union. Look at other jurisdictions like third world countries such as Iran. They have put up like a registration for Bitcoin miners, and they've put up a new law which says you're allowed to mine with Bitcoin if you do it with renewable energies. And this is why one of the biggest energy producers, Falan Energy, is in Iran producing a renewable solar plant, especially for using for mining Bitcoin. And who is interested in this topic can read a nice interview of mine, which was given out by the Austrian newspaper about Bitcoin mining in Iran. And this is just an example of how you can deal such challenges instead of bringing out like suggestions on forbidding a proof of work coins in the EU, which is nonsense.
I think this was a great closing remark, Mr. Ziadat. And what we could also do is when we share the panel via social media, we could also attach the report in the post, because I think this sounded pretty interesting. Because just last take from my side, my dream is always somewhat to see that, renewable energy, windmills, power the German industry. And at night, when we basically have excessive energy, I mean, there was often the idea of hydrogen, but we could also just mine green Bitcoin and basically, have like a win-win situation for basically all people involved. Okay, but that's it for today's panel. I think this was really great to have all you three here on this panel, because I even learned a lot, especially about regulation. This is always somewhat the topic where my knowledge is still a little bit lacking. So I would like to thank Rudolf Siebel from the BVI, Alireza Siadat from Enerton, and also Maximilian Bruckner from 21x6 Capital for joining us today. I wish you all a very nice day today, as well as our audience. And then I would say, see you soon.
Thank you very much.
Pleasure to be here. Thank you.
Thank you.